Making a PMS tax efficient. Where did this question come from? It comes from the fact that mutual funds today enjoy the highest tax efficiency in the Indian capital market, because you don't pay taxes on the dividend you receive if they come through your mutual fund investment, and you don't pay short-term capital gains. You also don't pay long-term capital gains. So essentially, if you are going to be invested in a mutual fund without selling your units for extended periods of time, you would probably not pay any taxes until you take out money. A lot of investors don't need money. They're just deploying their surplus capital and want it to grow. For such investors, the mutual fund suddenly becomes the preferred investment vehicle. And the PMS suffers from an inherent disadvantage. Is there a way to circumvent this? Luckily for me, when we started a PMS, the way I curated products itself was aimed at keeping trading low. So it is a good thing that philosophically we were not inclined to do more trading to create more short-term gains. But we can't do much about dividend income. Luckily, the dividend yields today don't matter so much as they did maybe a decade ago or even earlier. So today, on the value of your portfolio, the amount of dividend that you gain is not very significant. As an absolute sum for a lot of people, especially ultra HNIs, the dividend income will be very significant, and the taxation is close to 42%. But for the middle class person, it doesn't matter so much. In a PMS, whatever dividend we make generally is taxed at the marginal slab rate of the investor. So that's something we can't do much about. But we definitely can do something very, very correct in the capital gain approach, in the way we view investing from the perspective of creating capital gains. And here we have been very consistent from the time we started a PMS. We don't trade. We generally prefer to consciously avoid trading. A trade may happen under very, very rare circumstances. We don't buy something with the intent of trading. We always invest. We buy only with the intention of holding for long periods of time. And this deliberate approach to creating PMS products has helped the iThought product ecosystem a lot, because we don't have to change ourselves. We just have to be ourselves, stick to what we started with, stick to the same approach, and be very, very disciplined. That discipline actually saves us a lot of taxes. We don't sell for the sake of selling. We don't create taxable income. So the investor need not incur capital gains unless it is absolutely necessary. In the sense, some investments have to be sold. If you hold a stock which goes to a very high valuation and you know that that is not sustainable and you are not going to make any income by holding on to it for a longer period of time, at that time you need to book profits. In that situation, we book profits and the investor pays taxes. From a tax perspective, it's actually efficient. When you sell a mutual fund unit, you sell the entire unit. Here you only sell a particular scrip. So assume there is 20% churn in a year. You are going to pay long-term capital gains on the 20%, which would be 12.5% of 20%. Even if it's an ultra HNI, they will get a surcharge added to the 12.5%. So the tax would be incurred only where investment merits are very, very strong. And this is not something that we created in the last 6 months or 1 year, seeing the changes in taxation. This is what we created as a way of working on the day we started our PMS. So effectively, we have stuck to our investment process in the way we own businesses for longer periods of time, and we have always been driven by investment merits when it comes to selling an investment. And all three align with the financial interest of the investor, even if he is going to pay taxes. Now, could we have done this better? If we didn't have these beliefs from the day we started our PMS, the answer is a simple, plain, straightforward no. Because these things cannot be suddenly juxtaposed or superimposed on a process which involves a lot of churn. Behaviorally, you need to be oriented towards a certain style of investing in every product, and you have to stick to that style of investing in the product, irrespective of what changes you see in taxation. And importantly, the way in which you invest, own and sell should maximize the efficiency of capital for the investor. Taxes should be incidental. So, if you are doing all these things right, there should be a justification in incurring the tax. Yeah, I pay the tax, so what? Should be the approach which the investor should be willing to take. But the investing has to be at that level. And that is what we have been striving for from the day we started iThoughtPMS. Luckily for us, we have done reasonably well in establishing, maintaining, improving and sustaining the investment process in such a way that it supports even a clear disadvantage in taxation and overcomes it. So, in that sense, I think our philosophy is what helps us manage the disadvantage which PMS have vis-a-vis mutual fund on capital gains, and the philosophy supported by the process helps us to manage the investment in a far more effective way than probably a mutual fund which does not have taxes. And we hope to keep improving both the philosophy and the investment process to the changing needs of the market, and always aligning to what it takes to give the investor a sustainable and credible ownership experience with his investments in our PMS. Thank you for watching this video.